Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Investment Banking Explained, Key Roles, Functions and Career Insights for 2024. Valuation Methods. Valuing a business or asset is one of the most critical steps in investment banking. The goal is to determine its worth, which serves as the foundation for negotiations and deal structuring. Investment bankers use several methods to calculate this value, depending on the situation. The most common valuation techniques include discounted cash flow, DCF, predicting future cash flows and discounting them back to their present value. Comparable company analysis, assessing similar companies in the same industry to estimate value. Precedent transactions, reviewing valuations from past deals involving similar companies. Each method has its strengths and weaknesses, so often a combination is used to arrive at the most accurate number. Accurate valuations help ensure fair deals for both buyers and sellers. Negotiation and deal structuring. Once the due diligence is complete and a valuation is agreed upon, it's time for negotiations. This stage is where the terms of the deal are hammered out, much like bartering at a marketplace, but on a much larger scale. Investment bankers serve as intermediaries, leveraging their expertise to secure favorable terms for their client. During negotiations, they address items such as purchase price and payment structure, key deadlines and performance conditions, contingencies like what happens if financial targets aren't met. After terms are finalized, the deal structure is created. This refers to how the transaction will unfold, whether it's an outright purchase, a merger, or a joint venture. A well-structured deal balances risk and reward for all parties involved. Closing the deal. Closing is the final step, where everything comes together. At this point, all legal documents are signed and the deal officially becomes binding. But getting here isn't always simple. It requires coordination, attention to detail, and often a bit of last-minute problem-solving. In this phase, investment bankers focus on things like resolving any last-minute issues that arise, ensuring compliance with regulatory requirements, facilitating the transfer of funds or assets. Once the deal is closed, the client's goals are achieved and the investment banker's hard work pays off. It's a high-pressure yet highly rewarding conclusion to the process that can have a significant impact on businesses and industries. By understanding these steps, it's clear that investment banking goes far beyond convincing parties to sign a deal. It's a meticulously planned and executed process where strategy, analysis and negotiation all play equal roles in delivering results. Regulatory environment in investment banking. Investment banking operates within a tightly regulated framework. These rules ensure transparency, protect investors, and maintain stability in the financial system. The regulatory environment is complex, constantly evolving, and can significantly impact how investment banks function. Key regulatory bodies. Several organizations oversee the activities of investment banks. Their role is to enforce rules and monitor compliance. Securities and Exchange Commission, SEC. The SEC is the main watchdog for U.S. financial markets. It ensures fair trading practices, stops fraudulent activities, and requires accurate financial reporting. For example, investment banks must comply with SEC rules when underwriting IPOs or trading securities. Financial Industry Regulatory Authority, FINRA. FINRA focuses on the conduct of brokerage firms and professionals. It oversees licensing, monitors trading behavior, and enforces ethical standards. Think of FINRA as the referee in the world of securities trading. Federal Reserve, Fed. For larger financial institutions, the Fed plays a key role in overseeing their capital levels and risk management strategies. It ensures the financial system remains sound. International regulatory bodies. Investment banks operating globally face additional oversight from organizations like the Financial Stability Board, FSB, and the Basel Committee on Banking Supervision. These bodies set international standards to ensure banks maintain proper risk management practices. These agencies and regulators ensure investment banks stay accountable and act in the best interest of the market. Impact of regulations on operations. Regulations profoundly shape how investment banks run their businesses. They influence strategies, costs, and even the types of services banks can provide. Compliance costs. Meeting regulatory requirements isn't cheap. Investment banks spend heavily on legal staff, compliance officers, and technology to track and report transactions. Regulations like Dodd-Frank, introduced after the 2008 financial crisis, imposed stricter oversight and increased these costs significantly. Risk management. Regulators require banks to maintain certain capital levels to cushion against financial shocks. These rules, such as the Basel III framework, limit the amount of risky activities banks can take on. While this reduces the chance of another financial crisis, it can also restrict profit opportunities. Operational restrictions. Some regulations, like the Volcker Rule, prevent banks from engaging in proprietary trading, where they trade with their own money instead of a client's. This limits their ability to profit from risky trades and pushes them to focus more on client-oriented services. Transparency obligations. Investment banks must disclose detailed information about their operations, deals, and financial health. This ensures markets can function properly, but requires constant monitoring and documentation. To put it simply, regulations act as both guardrails and speed bumps. They protect the system but can slow banks down or increase their costs. Adjusting to these rules is an ongoing challenge, with banks carefully balancing compliance and competitiveness. By following these regulations, investment banks maintain trust with clients, investors, and the market at large. Career paths in investment banking. Investment banking offers a structured yet challenging career path, with opportunities to grow from entry-level roles to senior leadership. Each step on the ladder brings new responsibilities and rewards. Here's a closer look at the key roles and skills that drive success in this fast-moving industry. Analyst and associate roles. Analysts and associates are the backbone of investment banking operations. These entry and mid-level positions handle the heavy lifting in terms of research, analysis, and client support. Here's what their roles involve. Analysts, first 2 to 3 years. Recent graduates often start as analysts. Responsibilities include creating financial models, preparing presentations, and conducting market research. Analysts spend long hours crunching numbers to provide data-driven insights for senior bankers. Associates, post-MBA or promotion. Associates assist in managing projects and guiding analysts. They focus on client presentations, deal coordination, and maintaining client relationships. This role demands strong multitasking abilities as they juggle multiple deals at once. These roles offer a steep learning curve and are known for their demanding hours and high-pressure environment. However, they provide unmatched exposure to financial markets and deal-making. Managing directors and executives. As you move up the ranks, roles shift from hands-on execution to strategic decision-making and client management. Reaching senior-level roles requires years of experience and proven success. Vice presidents, VP, act as a bridge between associates and senior executives. Oversee deal execution and ensure client goals are met. Play a key role in mentoring junior staff. Directors or senior VPs focus mainly on building client relationships and securing deals. Strategize deal structures and negotiate terms with clients and stakeholders. Take on more visible leadership responsibilities within the firm. Managing directors, MD. The pinnacle of the investment banking ladder. Responsibilities include bringing in new business, managing high-profile accounts, and steering the division's profitability. MDs are often the face of the bank for major clients, which makes strong connections vital. Climbing to these levels can take a decade or more. Along the way, professionals must consistently deliver results and cultivate a wide network of industry contacts. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.